Hey, welcome to The Explainer. Today, we're putting Avnet's stock under the microscope. Its performance has been absolutely incredible, and we really want to know what's going on.
Just look at this number. We're talking a surge of almost 65% this year alone. Now that is the kind of performance that makes everyone stop and ask, whoa, what is fueling this incredible run?
And that really brings us to the big question here, right? Is the company's actual health as strong as its stock price suggests? So what we're going to do is a full financial health checkup. We'll dig into the data to see if the fundamentals, the real numbers, actually justify this massive rally.
All right, let's get right into it. First up, our first diagnostic, valuation. Basically, has the price gotten way ahead of the actual company?
And a really common tool for this is the PE ratio. That's price to earnings. You can just think of it like a price tag on the company's profits. The higher that number, the more of a premium investors are willing to pay for every single dollar the company earns.
Okay, and this is where it starts to get really interesting. Right now, Avnet's PE is sitting over 32. To put that in perspective, investors are now paying more than double what they were paying on average for the last 3 years. That is a massive jump in what people expect from this company.
And it's not just earnings. We see the exact same story with cash flow. The price investors are paying for every dollar of cash the company generates, that has just skyrocketed, up over 150% compared to its recent average. So yeah, on two really key metrics, that price tag is looking very high.
So, okay, the stock looks expensive. But hey, maybe the company's profit engine is just absolutely firing on all cylinders to justify it, right? Well, let's check that out. To see how that profit engine is running, we're going to use a great metric called ROIC, or Return on Invested Capital. It's a fancy name, but it's simple. It tells us how good a company is at turning the money it invests into actual profits.
And this is where we hit a potential red flag. Instead of revving up, Avnet's profitability has actually gone down. Its current ROIC is just over 6%. That's a pretty big drop from its 3-year average of over 9%. So, that profit engine, it kind of looks like it's sputtering.
And it's not just ROIC. It's the same story across the board. Take return on equity. That's how much profit they're making for shareholders. Well, that's dropped by more than half from its recent average. So now you've got this really clear imbalance. Stock price is way up, but the company's ability to make a profit, that's heading down. Okay, on to our third diagnostic, growth. And this is where the story gets, really conflicting. Here's the thing you gotta grasp. The stock price is acting like the company is in this huge growth phase, but when you look at the actual business, the fundamentals, they're telling a completely different story. Just look at this contrast. It's wild. On one hand, yeah, investors have gotten amazing returns, over 62% in the last year. But on the other hand, the company's actual net income, its profit, has dropped by almost 35% in that same period. How does that work? And it gets even more dramatic than that. The company's free cash flow, and you can think of that as the oxygen a business needs to breathe, it has absolutely plummeted. We're talking down over 80% in the last 12 months. This is a huge disconnect between what the market thinks is happening and what's actually happening in the business.
All right, so with all these conflicting signals on growth and profitability, let's run our fourth track. Let's look at stability. How solid is the company, and what is it doing for the investors who stick around?
Now, here is some good news. Avnet has been a really solid dividend payer. They've actually increased their dividend for 13 straight years. And those payments, they've been growing nicely. Plus, it's all backed by a pretty healthy balance sheet. Their debt is totally manageable. But yeah, there's always a but, isn't there? A closer look at the numbers shows a potential yellow flag, a little warning about how long they can keep this up. See, there's this thing called the dividend payout ratio. It just tells you what chunk of the company's profits are going out the door as dividends. And right now, Avnet is using almost 55% of its profits for those payouts. That's nearly double its recent average. If those profits don't bounce back, and soon, that could really start to put a strain on things. Okay, so after running all these tests, we've looked at valuation, profitability, growth, stability. We've arrived at the final diagnosis. We have to ask, what is Avnet really worth?
And this is where it gets really fascinating, because the market seems to be caught between two totally different ideas of what the company's worth.
See, if you value the company based on its potential earnings, you get a price of about $104. Looks undervalued. But if you value it based on that free cash flow we saw earlier, the stuff that's been plummeting, you get a price of just $68. Suddenly, it looks overvalued.
And where's the stock price today? It's sitting right around 78 bucks, almost perfectly in the middle of those two numbers. It's like the market itself can't decide which story to believe, the optimistic earnings story or the pessimistic cash flow story.
So let's wrap this up. The big takeaway from our health check is a company with a sky-high stock price, but its vital signs are looking kind of weak. The valuation is stretched, profitability is down, and real growth in income and cash flow is actually negative.
And that leaves us with one final big question to chew on. Is Avnet's stock price for perfection? Is the market correctly betting on a huge, massive turnaround? Or is this a sign that the market is just completely disconnected, ignoring some really serious warning signs?